All right, so I want to ask you something. What if I told you there are apartment buildings in Canada right now, like right now, where you can buy a door for 60, maybe $70,000? That same door in Toronto or Vancouver would be 300 to $500,000 easy. So the obvious question is, why isn't everybody just going there and buying there, right? Well, I'm going to tell you exactly why. And I'm also going to show you three specific markets in the Canadian prairies that I think serious cash flow investors need to be paying attention to. Because we're in a period right now where appreciation first investing is getting absolutely destroyed. Negative cash flow properties, high interest rates sticking around, rents are softening in the big cities. Investors who were betting on Toronto and Vancouver to keep going up are having a really tough time right now. So today we're going to talk about three markets where the rules are completely different. And I mean like completely different. Now, before I get into this, I want to be clear about something. These are not get rich quick markets. I'm not going to sit here and tell you to pack your bags tomorrow and go buy a 20 unit building in northern Saskatchewan just and watch the money roll in. That's not this. What these markets do offer is cash flow. Real, positive, from day one cash flow. If you buy right, if you screen your tenants right, and if you have the right systems in place. And that's really what I want to talk about today. Not just the opportunity, but the real operational picture. Because these markets will reward you if you do the work, and they will punish you if you don't. So let's get into it. The three markets I want to cover are Lloydminster, Swift Current, and Prince Albert. And they are three very, very different animals. I kind of think of them as a spectrum, like from lower risk on one end all the way up to maximum return, but maximum effort on the other end. So let's start with Lloydminster. Now, if you don't know, Lloydminster, it is, and this is genuinely unique in Canada, it's the only city in the country that straddles a provincial border. So half the city is in Alberta and half of it is in Saskatchewan. So it sits right on that border between the two provinces. I've been there and you can actually drive right down, I think it's 50th Street, and 50th Street is the Alberta-Saskatchewan border. And that creates something really interesting for investors. Average home prices right now are sitting somewhere between $300,000 and $410,000. There's even some nice half duplexes on realtor.ca right now for under $200,000. And the inventory in this market is incredibly tight. We're talking under 150 active residential listings. So, from a vacancy standpoint, that supply shortage is doing a lot of the work for you. And when you've got that kind of tight supply and strong rental demand, your vacancy risk is dramatically lower. Now, here's where the arbitrage opportunity comes in. And this is the thing that most people miss about Lloydminster. If you're buying a multifamily property there, where you position your operations matters. The Alberta side has no provincial sales tax. The Alberta side also has slightly more landlord-friendly legal environment. Saskatchewan has different lease structures, different tax considerations. So smart investors are looking at buildings where they can operate from the Alberta side while still capturing the demand from both sides of the border. I mean, it's nuance, right? But it's the kind of nuance that adds up to thousands of dollars a year in your pocket or out of your pocket. So it matters. Now, what drives the rental demand in Lloydminster? Oil is the big one, and agriculture, and some industry. So this is an industrial and resource economy. And what that means for you as an investor is, and I want you to hear this, okay? You need to underwrite for heavier wear and tear on your properties. These are oil field workers, these are industrial workers, and they're not hard on your property out of malice or carelessness. It's the nature of the work they do. They wear heavy boots, they come home dirtier, that kind of thing. And so, you're running your numbers on a deal in Lloydminster. You will better be budgeting realistically for maintenance and turnover. Don't underestimate it. But if you buy a solid multifamily building or even a single family with a legal suite, which adds that income buffer, screen your tenants carefully, manage it well. You've got a tight market there. So you've got strong demand from the industrial workers on monthly leases, and you've got real cash flow play. So that's Lloydminster. The opportunity is in understanding the two provincial systems and positioning yourself to take advantage of that. Market number 2 is Swift Current, the steady Eddie cash flow engine. All right, so now moving to market number 2, and this is I kind of love this market for a specific type of investor, and it's Swift Current, which is in southern Saskatchewan, southwestern Saskatchewan. And it's right along the Trans-Canada Highway, so there's great access. And the thing about Swift Current is it doesn't really get the headlines. Nobody's making YouTube videos about Swift Current Saskatchewan, right? But that's kind of the point. Average home prices here are somewhere in the 250 to 330 range. And there's even right now, there's a decent little single family house on realtor.ca. Like right now, this is June 18th, 2026. It's $168,000 for a single family home on a nice big lot. That would make a great burr. So we're talking about a genuinely accessible entry point. And when you start running the numbers, carrying costs against rental income, you can find properties here that are cash flow positive literally from day one. Like not in theory, but actual like real money in your pocket. Now, here's the thing that really stands out to me about Swift Current, and it's not the purchase price, it's the vacancy picture. New residential construction here has all but ground to a halt because the material costs and the labor costs, it doesn't pencil out for developers to build new supply on a mass scale. So what that means is your existing rental stock has almost no new competition coming in. And the renters in this market are highly localized. They're long-term tenants. They're blue-collar workers who are not moving every year. These people were born here, raised here, will likely live here long-term. And so they have a stake in that community. This is a tenant base that really they plant their roots, right? And you know what that means for you, right? Is that low turnover, low vacancy, and a much more manageable operational situation compared to some of the other markets we'll talk about in a minute. Now look, I want to be honest about what Swift Current is not. You're not going to see big equity growth here from market movement. If you buy in Swift Current, you're buying for cash flow, period. Modest appreciation, maybe 2 to 4% in a good year. But that's not why you're there. But keep in mind, too, though, that the value of your Canadian dollar is dropping by 8 to 10% per year. So there's that. Buying that asset that's appreciating at a steady, slow 2 to 4% per year in addition to the cash flow, you're still coming way ahead. You're there because you want to build a portfolio that actually generates positive monthly cash flow, that has stable, long-term tenants, that you can potentially manage from out of province without being kept up at night worrying about tenant problems or doing evictions. I think of this as the perfect entry market for the investor who's been really frustrated by the negative cash flow game in the bigger cities and just wants to see some green on their spreadsheet for once. It's a pure cash flow play there. Swift Current, like I said before, it's the steady Eddie cash flow engine. Now let's talk about the market that is going to scare a lot of investors away, which is exactly why the opportunity is there. All right, I want to be straight with you right from the start. This market is not for everybody. In fact, I would say it's not for most people. And that's not me trying to be dramatic. It's just the reality of what this market requires from you as an operator. But here's the math that catches your attention. Multifamily buildings, we're talking like 12, 15, 20 units, are trading at $75,000 to $85,000 per door in Canada right now. So you understand what that means for your cap rates? We're talking about some of the highest cap rates in the country, and the demand there is real. Prince Albert is the retail hub, the medical hub, the government services hub for the entire northern half of Saskatchewan. So there's forestry, mining, corrections, healthcare. You've got institutional employment driving permanent demand for mid to low tier rental housing. And that demand isn't going anywhere. So the opportunity is legitimate. The math is legitimate. But here's the truth. And this is where I need you to really pay attention, okay? Prince Albert requires a hardened investor mindset. And I mean that. Like, this is not a set it and forget it market. This is not a market where you can install a property manager, send out monthly statements, and just check out. Now, there are, of course, going to be some pockets in town where you can do that. But as a general rule, it does take a more active approach. Active, intentional property management is not optional here. It is the job. Tenant screening in PA cannot be done casually. You need to understand the local neighborhood dynamics, block by block in some cases. You need to match your buildings to stable employment areas. You need to know which areas have the tenant profiles at work for your operation. And if you don't, if you screen loosely, if you buy in the wrong pocket of the city, your vacancy projections will get destroyed by bad debt, by evictions, by property damage, you name it. To be clear, I'm not saying this to scare you. I'm saying this because I believe in giving people the right picture. I would rather that you hear the hard truth from me now than learn it the expensive way with like a 15 or 20 unit building. So if you're a seasoned investor, if you have bulletproof systems, if you can do a proper value add on one of these buildings, get the right tenants in, enforce your lease, and manage it actively, the upside is enormous. The returns you can generate in Prince Albert really are exceptional. And that's why smart, experienced money is starting to pay attention to that market. But you need to go in, again, let me tell you, you need to go in with your eyes open. The reward matches the effort. All right, so let me tie this into a bow for you here and bring it all together. We've got three markets, three completely different investor types. Lloydminster, that's your arbitrage play. Tight inventory, industrial demand, the provincial advantage for the investor who's willing to understand the nuances of operating in two different provinces. You have Swift Current, that's your steady cash flow engine. Low entry price, stable, long-term tenants, positive cash flow from day one, minimal appreciation, but maximum sleep at night factor, which is perfect for the out-of-province investor who wants the yield without the headache. And Prince Albert. This is your high-yield frontier, if you will. Some of the highest cap rates in the country. Real institutional demand. But it demands an experienced, active, hardened investor who's not going to cut corners on your tenant screening or on your property management. Now, and I want to be clear about this, none of these are for people who think real estate is passive. You know, I've said this before, and I'm going to keep saying it, that investing, it can be manageable, it can be efficient, and it can be systematized. But it is not passive. People throw that passive income word around in real estate investing a lot. Real estate investing is not passive. You need to be plugged in. You need to be engaged. It requires time, it requires effort, and it requires the right systems. And this is huge, it requires the right tenants. So whether you're buying in Lloydminster or Swift Current or Prince Albert, the fundamentals don't change. You need to buy right, screen your tenants, know your numbers, and have your maintenance reserves in place. And build your power team on the ground, because they're the lifeblood of whether this sinks or swims. That stuff never changes, no matter what market you're in. So thanks for watching, and if you like this video, I appreciate if you subscribe and check out the other videos that I've put out, and I'll see you next time.